We think there should be more scope for rally in the next year or so because we think that with the good news in vaccine and the gradual economic recovery that is going to go along with the vaccine development, we think that Europe is a more cyclically exposed and sensitive sector to the global economic recovery. And as a result, we have actually, at the beginning of the month, added to more of our UK exposure because we think that these positive news with the vaccine, with the recovery, which will be beneficial to European assets, in particular, more so next year.
Janet, one of the issues, though, after this very strong performance in November, it's hard to see a clear line higher. We keep talking about money being dragged off the sidelines, but we know markets typically do not go up in a straight line. So were we looking at a setback before we get to a higher position?
Yeah, I think, well, this is possible. As you mentioned, markets don't go up in a strict line. So given the very strong rally we've seen in November, we won't be surprised if there is some back and forth in the markets, especially if we see a rise in the COVID-19 cases, because after all, it's going to be Christmas in Europe, and I think people would be gathering more. And as a result, we won't be surprised if cases pick up and then markets get sensitive. And actually, in the short term, we're going to see maybe some weakening economic data, as we've already seen in those PMIs data in Europe, in particular in the services sector. So I think markets could be sensitive to those news. And of course, a lot of those vaccine news is being digested by markets. And after all, we may need even more positive breakthrough, for example, in the US stimulus talks or the better economic recovery globally in order for that rally to happen. But we think will continue, but with some setbacks along the way.
Yeah, Janet, I just wanted to push a couple of ideas your way and just get your read on to what extent you think they're important. One is the rebalancing for those who follow a 60-40 type allocation approach. Institutionally, we are on the last trading day of the month. To what extent are we going to see some rebalancing of portfolios away from equity back to fixed income? And I guess my second point would be, for anybody who's made reasonable returns so far this year, what do you think the chances are that they may just actually take profit at this point and step out of the market because there is the risk of losing some of those gains into year end?
Well, I think both of those technical factors could be at play. Because I think if you follow a particular asset allocation or benchmark, 60-40, maybe you need to rebalance. But I think a lot of asset managers or wealth managers nowadays, they have more flexibility in terms of their asset allocation and targets. They could go a bit more overweight within that range. So I think wealth managers and asset managers, they are still quite positive. And so as a result, they may rebalance a bit, but may not be to the extent that markets have been expecting. And I think, yeah, there may well be some profit taking. I think a lot of people appreciate that the rally is pretty strong. So that's why we actually take into account the fact that there could be some short-term volatility and setback. But our eye is for more longer-term gains, in particular next year. So that's why we remain positive on 12-month view.